What is going on, guys? It's me, Kavi, you, Kavi2X, NQ Kavi, yada yada yada. I'm back, and it's time for the real cool kid stuff. You'll notice I'm filming on the same day because I'm like, oh, gotta get that shit over with, blah blah blah. I'm gonna make this video about PD arrays. The PD arrays stand for premium discount arrays. So ICT PD arrays are key price structures that represent areas where institutional traders, buyers, sellers are likely to buy and sell. So for some examples of PD arrays would be fair value gaps, order blocks, previous highs and lows, equal highs and lows, session highs and lows, Fibonacci premium and discount zones, and market imbalances. Alright boys, let's hop into the first example. Let's hop into the first example, alright? So, a fair value gap in terms of ICT says they're inefficient price zones that form when price moves away too fast, leaving a gap in the market. Okay? Now the correct structure for this would be it's like a 3 candle formation. It could be any 3 candles. The middle one must be an expansion candle. I'll touch on that later. But yeah. So some examples are bullish for value gap, bearish for value gap, inefficiencies, price imbalances, and displacement gaps. Now the only ones I really do use are bullish and bearish gaps. Inefficiencies you can use a BISI or a SIBI, but I will not cover that right now because I do think learning the typical fair value gap is more important. Now the reason these gaps work is because markets, I think, as you know, they don't move perfectly. They don't move straightly up. They don't move straight down. They go in 3 motions: distribution and accumulation, alright, and manipulation, of course. So, knowing this, price displaces aggressively in one direction, and it leaves behind unfilled areas, which the market must return to fill in those imbalances. Fair value gaps are just visual representations of those areas, and it makes them extremely useful for identifying potential retracements, continuations, and high probability entries when aligned with market structure and time. So time and price. Alright guys, let's hop into this example kind of. I might have a live example of this, but it is what it is. Fair value gaps are fairly easy. So look, I'm sure you can identify from the first video that look, oh, we're bullish as shit. So we have this higher high, have this, I think it's a lower low, I'll be honest. But yeah, so if we have this lower low, we have this higher high, what can we expect? We will expect price to, well, in this case we move aggressively up, right, forming this huge like big ass candle, therefore forming a fair value gap. What price will likely do is we'll trade back into this gap to kind of fill in that inefficiency, and we will continue in the desired trend. Same for this bearish example. What do? We're in a clear buy model, we just tank. But what happens when we tank? We tank aggressively with this large expansion candle, form a fair value gap, right? We see this bullish candle trade into it, right? And we clearly displace out of that. Alright, so let's hop into some live examples. This video will be short because my parents are coming back home, which kind of sucks because I really wanted to teach you guys. Oh no! Alright. Honestly, bro, fair value gaps are everywhere, bro. Oh, bro, this is the exact bullish example. Like, genuinely, it's the exact one. If you go here, yeah, it's the exact same. That. I think that's it for this shit, bro. Like, there's nothing I can really touch up on. It's like 4 minutes, but I'll probably pause it or I'll stop. I don't know which one, man. Yeah, I think I'm gonna stop the recording. I'll touch up on the other PD arrays, right? Like, we have our order blocks, equal highs and lows, and liquidity sweeps. Those are the real saucy ones. I'll do this as like a part 1. Alright, come back in part 2, guys. Bye.